Hi, Dan Kurz, DK Analytics. Thanks a lot for tuning in. It's February 14th, 2016. We would like to draw your attention to a post that we just published on negative interest rates. We're going from zero interest rate policies to negative interest rate policies. And at the same time, it looks like the global fiat currency powers that be are looking to make cash, banknotes, bills increasingly rare and in some instances even illegal for the payment of debts in the private and the public arena. Let us touch on some of the highlights and ask you to look at our site for details on this. It's post number 14. It's on our website, dkanalytics.com. It's under the blog section. And here's the nub of it. Central bankers, our global central planners, have, as you know, long shafted creditors, depositors. They've conducted monetary policy for the benefit of debtors, the biggest of which are obviously the governments, and at the expense of creditors and savers, and also including depositors in banks. You know, we all know that your savings accounts and checkings accounts have not earned a darn bit of interest. A buck or two, you don't even have to declare it in your tax return. That's how abysmally low it's been. So instead of having a return on money you provide to banks, you've been getting nothing. Instead of having some kind of benefit for forsaking immediate consumption, in other words, getting a real return, and having some kind of compensation for the monetary risks associated with all this money printing, you've got nothing. At the same time, your job prospects are worsening, full-time jobs are rare, participation rates are lower, and people are increasingly spending out of an empty pocket. This is bad enough as far as monetary policy is concerned, but they're now going to double down on what hasn't worked and has only transferred property from Main Street to Wall Street and K Street by instituting from Scandinavia down to Switzerland to the ECB to Japan, and probably a preview of coming attractions here in the United States. They are going to institute the ultimate insanity and perversion, and that is negative interest rate policies, where you, as creditors to banks, in terms of having your deposits there, be they checkings accounts or savings accounts, you are now going to be charged money, the ultimate outrage, for making your hard-earned cash available so that the banks can go out and lend it and have an even fatter spread. Well, guess what? That isn't always going to work for everybody. Some depositors are going to want to vote with their feet. This is important because if this really increases and spreads worldwide, in other words, that depositors get charged money for making their hard-earned after-tax savings available to banks, they might decide it's better for them to take their money and run. That is, to ask for $20, $50, $100 bills, whatever the currency is, and put it in a home safe instead of, and at least having 100% of it, instead of paying 0.5% or 1% or even more to the central banks. In this case, the banks that do business with the central banks are fractional reserve banks with whom we, know it or not, end up doing business. Well, if this happens, it's going to cause a huge potential liquidity and possibly even solvency problem for the banks where we have our accounts. Why? Because 50 to 60% of their funds, that is, the funding of their balance sheet, comes from, you guessed it, depositors. And bank notes or bills are but 5 to 10% of a country's GDP. And if people started to flee with even a small portion of their accounts, demand notes for them, then the banks, which have 1% of their balance sheet in banknotes, they are not going to be able to pay out a lot of banknotes. The rest is tied up. There's the discrepancy between depositors obviously being short-term funds and the banks investing it, as you would expect, in projects that are multi-year in nature. So there's an asset liability mismatch to boost. Long story short, our central bankers, our central planners, our Keynesian pals, quote unquote, have to nip this potential bank run story in the bud as they move to take away more of our money and shift it towards either Wall Street, K Street, or debtors. Obviously, the biggest of them all are the governments across the globe. And to prevent this whole nightmare of having a bank run, you conveniently make it illegal or difficult to pay with cash. You demonize cash, banknotes, bills, and then you start taking ATMs out of the system, as is happening in Scandinavian countries, and you make it, in essence, increasingly difficult for people to vote with their feet and take their money out of checkings and savings accounts that are morphing into, it costs you money to provide your money, and in so doing, adding additional insult to injury to savers, to creditors, to pensioners, to 401k participants, and just to retirees that no longer earn any interest for forsaking consumption at all. In a period when we all know that rents are rising, often double digits, high single digits, the same goes for healthcare insurance, utility bills, tuition costs. So your real world inflation experience is anything but what the government statisticians tell you. And they now want to, instead of offering zero interest rate on your checkings and savings account, they want to take you to negative and try to have you spend out of an empty pocket with increasingly poor job prospects. Well, some people are going to take their money and try to run, and they're going to try to prevent it by increasingly making it, well, by making it increasingly difficult for you to take your money out in the form of dollar bills or francs or euros or yen. And this is something that is of great concern because, as we discuss in our post, not only are you going to, in essence, have property transferred away from the depositor side of the ledger to the debtor side of the ledger, but you're going to be caught if you cannot cash out or close out the amount in your account that goes beyond your working capital needs, your bill paying needs. To have this extra money sloshing around in a bank earning negative rates is worse than stuffing it into a safe at home, right? Not only are you going to lose that ability if, in fact, this spreading tendency across the world to in essence demonize cash, to make it all electronic and no bills or notes, what's going to happen is you won't be able to get out of your electronic cash situation, which is going to also make you very susceptible to potential bail-in legislation. Now, talk about adding insult to injury. Many of you might not know this, but in the UK and in the United States, the powers that be have decided that depositors' monies, that is, your checkings and savings accounts, which provide 50 to 60% of a bank's balance sheet, right? That's their main source of financing. That is an unsecured claim, meaning you are an unsecured creditor, and you are going to be susceptible, that is, your funds, your checkings and savings accounts are susceptible to being used to make whole the derivatives casinos that the banks you're affiliated with are running in case they end up in the crapper. And your funds will be transferred from checkings or savings accounts into bank equity, and who knows what that's going to be worth if the crap hits the fan on these derivatives, which are off-balance sheet liabilities, which can go terribly wrong, especially as banks have no set-asides and they're extremely vulnerable to unexpected developments in interest rates should they go up, or in currencies, among other things. So you will then, as a Main Street creditor, a depositor, be it savings or checkings accounts, potentially be liable for making banks' derivatives bet good because the government thinks that the taxpayers in aggregate aren't enough and money printing is possibly not enough. That's how huge the derivatives bets are. We're talking about hundreds of trillions of dollars globally, and all the big banks are exposed. So think of it this way. You're moving from no interest rates to potentially negative interest rates. You're going to be potentially caught in the next 2008 event, the next financial crisis, the next credibility crisis, the next counterparty risk crisis. You are now bail-in funds for these banksters that have made extremely dangerous derivatives bets. So what are you going to do about all that? How do you protect yourself, if only at the margin? That's what our post delves into. You don't need to have all this foisted upon you. There's time to act with funds that you don't need in a working capital sense. And those are exactly the kind of things, that is, solutions, at least at the margin, that you should consider, that you need to be aware of and possibly act on before it's too late. That is the nature of our post number 14 in the blog section of our site. We hope you take a look. We hope you find it of interest. Caveat emptor, buyer beware, and depositors be doubly aware. Thank you. Bye-bye.